Welcome to Chapter 6, Measurement. Welcome, students. In this chapter, we will explore the concept of measurement within financial reporting, one of the most important topics in the conceptual framework. Our aim is to help you understand the various measurement bases and the factors to consider when selecting a measurement basis for assets, liabilities, and equity. The first topic that we are going to cover is an introduction to Chapter 6. After that, we are going to talk about measurement bases. Under measurement bases, we are going to discuss historical cost, current value, and under current value, we will cover fair value, value in use and fulfillment value, current cost. Then we go to our third topic, which is information provided by particular measurement bases. Under this topic, we're going to talk about historical cost, current value, and under current value, we again discuss fair value, value in use and fulfillment value, current cost. Our fourth topic is factors to consider when selecting a measurement basis. Under this topic, we will cover relevance, which includes characteristics of the asset or liability, contribution to future cash flows, faithful representation, enhancing qualitative characteristics and the cost constraint, historical cost, current value, factors specific to initial measurement, more than one measurement basis. The next topic is measurement of equity. Finally, we will discuss cash flow-based measurement techniques. We will provide clear explanations and examples for each topic to make the concepts easier to understand. Let's dive into the details. Introduction. Quantifying elements in financial statements. Elements recognized in financial statements, such as assets and liabilities, need to be quantified in monetary terms. This requires selecting a measurement basis, which is an identified feature, like historical cost, fair value, or fulfillment value of the item being measured. Applying a measurement basis to an asset or liability creates a measure for that asset or liability and for the related income and expenses. Consideration of qualitative characteristics and cost constraint. When selecting measurement bases, it's important to consider the qualitative characteristics of useful financial information and the cost constraint. This means different measurement bases may be chosen for different assets, liabilities, income, and expenses to provide the most useful and relevant information. Implementation of measurement basis in standards. Sometimes, a standard may need to describe how to implement the chosen measurement basis. This description could include specifying techniques that may or must be used to estimate a measure applying a particular measurement basis, specifying a simplified measurement approach that is likely to provide information similar to that provided by a preferred measurement basis, explaining how to modify a measurement basis. For example, by excluding from the fulfillment value of a liability the effect of the possibility that the entity may fail to fulfill that liability, own credit risk. In this topic, we've covered the importance of selecting appropriate measurement bases and the factors influencing these choices. Next, we will explore different measurement bases and their implications in financial reporting. In the next section, we will discuss measurement bases in detail, including historical cost and current value, and their subtopics. Measurement bases, historical cost. Overview. In this section, we will discuss the historical cost as a measurement basis. Historical cost measures provide monetary information about assets, liabilities, and related income and expenses based on the price of the transaction or event that created them. This approach does not reflect changes in values over time, except in cases of asset impairment or liabilities becoming onerous. Understanding historical cost. 1. Definition and application. Description. Historical cost is determined by the costs incurred in acquiring or creating an asset, which includes the consideration paid and any transaction costs. For liabilities, historical cost is the consideration received minus transaction costs. This method maintains the original transaction price, ensuring that financial statements are based on actual costs rather than fluctuating market values. For example, if a company buys a machine for $10,000 and pays $500 in transaction costs, the historical cost of the machine is $10,500. This amount will be recorded in the financial statements and used as the basis for future measurements related to the machine. 2. Non-transaction events. Description. Sometimes an asset or liability may arise from events that are not market transactions, making it difficult to determine a cost. In such cases, a current value is used as a deemed cost at initial recognition, which then serves as the starting point for historical cost measurement. This ensures that the asset or liability is initially recognized at a value that reflects its current worth. Example: if a company receives a donated piece of equipment with no clear transaction price, it might use the equipment's current market value as the deemed cost. If the equipment's current value is $8,000, this amount will be used as the starting point for historical cost measurement. 3. Updating historical cost. Description. The historical cost of an asset or liability is adjusted over time to reflect several factors. Consumption, depreciation or amortization. Over time, assets such as machinery or patents lose value as they are used. Depreciation for tangible assets or amortization for intangible assets allocates the cost of the asset over its useful life. Example: if the machine bought for $10,500 is expected to last for 10 years, the company might depreciate it by $1,150 per year. This annual depreciation reduces the machine's book value and reflects its decreasing usefulness over time. Payments received. Any payments received that reduce the asset's value. Example: if a company has accounts receivable, money owed to it, and it receives partial payments, these payments reduce the value of the accounts receivable. For instance, if the company is owed $5,000 and receives $2,000, the accounts receivable balance will be reduced to $3,000. Impairment. Events that make the historical cost of the asset no longer recoverable, such as damage or obsolescence, require impairment adjustments. This ensures that the asset's recorded value does not exceed its recoverable amount. Example: if the $10,500 machine is damaged and its value drops to $6,000, the company must recognize an impairment loss of $4,500, reducing the machine's book value to $6,000. Interest accrual. Any financing components associated with the asset, such as interest on a loan used to purchase the asset, are also considered in historical cost. Example: if the company financed the machine purchase with a loan that incurs $200 in interest annually, this interest cost will be added to the asset's value, adjusting the book value accordingly. Liabilities. The historical cost of a liability is updated to reflect fulfillment, payments or actions that reduce the liability, such as making payments to settle the obligation. Example: if a company owes $1,000 to a supplier and pays $400, the liability is reduced to $600. Onerous liabilities. Events that increase the obligation to such an extent that the liability becomes onerous. This ensures that the liability reflects the true extent of the entity's obligation. Example: if new regulations increase the cost of fulfilling an environmental obligation from $5,000 to $7,000, the liability is adjusted to reflect this higher cost. Interest accrual. Any financing components associated with the liability, such as interest on borrowed funds, are also considered. Example: if a company takes out a loan with an annual interest of $300, this interest will be accrued and added to the liability. 4. Example: amortized cost. Description. One way to apply historical cost to financial assets and liabilities is through amortized cost. This method involves estimating future cash flows and discounting them at a rate determined at initial recognition. The discount rate for variable rate instruments is updated to reflect changes. Over time, the value is adjusted to reflect interest accrual, impairment, and payments received or made. Example: If a company issues a bond with a face value of $1,000 and receives $950 after transaction costs, the historical cost is $950. Over time, the company will adjust this value to account for interest payments and any changes in the bond's value due to market conditions. If the bond pays $50 in annual interest, the company will recognize this interest income, adjusting the bond's carrying amount. In summary, historical cost is a straightforward measurement basis that provides stability and reliability by reflecting the original transaction prices, with necessary adjustments over time for consumption, impairment, and financing components. This method ensures that financial statements provide a consistent and understandable picture of an entity's financial position. Measurement bases, current value overview. Current value measurement bases provide updated monetary information about assets, liabilities, and related income and expenses. Unlike historical cost, current values reflect changes in estimates of cash flows and other factors at the measurement date. Current value measurement bases include fair value, value in use, fulfillment value, and current cost. Current value. 1. Fair value. Description: fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. This value reflects the perspectives and assumptions of market participants. Essentially, it's what you'd get if you sold the asset or paid to settle the liability today, considering what people in the market would pay or require in return. Example: imagine you own a piece of land. To find its fair value, you look at similar pieces of land being sold in the current market. If similar plots are selling for $100,000, then the fair value of your land would also be around $100,000. This is because that's the price others in the market are willing to pay for such land. Determination. Fair value can be determined directly by observing prices in an active market where similar items are regularly bought and sold. When such direct observations aren't possible, fair value is estimated using techniques that consider factors such as future cash flows from the asset, time value of money, meaning how much future money is worth today, the risk of those cash flows not being realized, and any other relevant factors like liquidity or market conditions. Practical scenario. Let's say your company owns a piece of machinery that can't be sold in a ready market. To determine its fair value, you estimate the future cash flows it will generate, adjust for the uncertainty of those cash flows, and apply a discount rate to calculate their present value. This gives you the machinery's fair value. 2. Value in use and fulfillment value. Value in use. Description. Value in use is the present value of the cash flows or other economic benefits that an entity expects to derive from the use of an asset and from its ultimate disposal. It reflects the entity's own expectations and plans for the asset rather than the market's perspective. Example: suppose a company owns a factory. The value in use would be calculated by estimating the future cash flows the company expects to generate from operating the factory and then selling it at the end of its useful life. If the company expects to make $1 million a year for 10 years and sell the factory for $500,000 at the end, the present value of these amounts, discounted at an appropriate rate, represents the factory's value in use. Fulfillment value. Description. Fulfillment value is the present value of the cash or other economic resources that an entity expects to transfer to fulfill a liability. This measure includes all the costs the entity expects to incur to settle the obligation. Example: imagine a company has a legal obligation to pay $50,000 to settle a lawsuit in 5 years. The fulfillment value would be the present value of that $50,000, considering the time value of money and the company's cost of funds. If the company expects to incur additional costs of $10,000 to settle the case, those costs are also included in the fulfillment value. Entity-specific assumptions. These measurements use the entity's own assumptions rather than market participants' assumptions. This means that the entity considers its own plans and expectations for cash flows from using an asset or fulfilling a liability. Practical scenario. A company plans to operate a piece of equipment for 5 years, expecting annual maintenance costs of $20,000. The value in use is calculated by estimating the present value of these costs and the expected cash inflows from using the equipment. If the company's discount rate is 5%, these future costs and cash inflows are discounted back to their present value to determine the equipment's value in use. 3. Current cost. Description. Current cost is the cost of an equivalent asset or liability at the measurement date. For an asset, this means the amount you would pay today to acquire the same asset, including transaction costs. For a liability, it's the amount you would receive today to assume the same liability, minus any transaction costs. Example. If a company needs to replace an old delivery truck, the current cost would be the amount the company would pay today to buy a similar new truck. If a new truck costs $30,000, including $2,000 in transaction costs, the current cost of the truck is $32,000. Determination. Sometimes, current cost cannot be observed directly and must be estimated. For example, if prices are available only for new assets, the current cost of a used asset might be estimated by adjusting the new asset's price for age, condition, and any other relevant factors. Practical scenario. If a company's existing equipment is 5 years old and a new piece of the same equipment costs $50,000, the current cost might be estimated by reducing the new equipment's price to reflect 5 years of depreciation and wear and tear. If the depreciation rate is 10% per year, the current cost of the old equipment might be around $25,000, assuming straight-line depreciation. Summary. Current value measurements provide a dynamic view of an entity's financial position by reflecting the latest market conditions and expectations. These measurements are crucial for providing relevant and timely financial information, helping stakeholders make informed decisions. By understanding fair value, value in use, fulfillment value, and current cost, you can better grasp how assets and liabilities are valued in a way that reflects their true economic impact on an entity at any given time. Information provided by specific measurement bases. This section of the conceptual framework is focused on understanding what kind of information each measurement basis gives and why this information is useful for users of financial statements. Let's break down each subtitle with detailed explanations and examples. Historical cost. Relevance to users. Information about historical cost is relevant because it tells users how much was originally paid for an asset or the original amount received for a liability. This helps users understand the initial investment and can be used to track the usage and value of these items over time. Example. A company buys a machine for $50,000. This amount is recorded as the historical cost. Over time, the machine is used and its value is depreciated. After 5 years, the book value might be $30,000. This historical cost and depreciation tell users how much of the machine's value has been consumed and what is left. Predictive and confirmatory value. Historical cost helps predict future costs and margins by providing a basis for comparison. It also confirms past predictions and decisions about resource allocation. Example. If a company plans to replace the machine every 5 years, the historical cost information helps in predicting the timing and amount of future expenditures for new machines. Fair value. Market participants' expectations. Fair value provides information about the current price at which an asset can be sold or a liability can be transferred, reflecting market participants' expectations about future cash flows. Example. If the machine bought for $50,000 is now worth $40,000 in the market, the fair value of $40,000 provides a realistic and current estimate of the machine's worth, which can guide selling decisions. Predictive and confirmatory value. Fair value is useful for predicting future cash flows based on current market trends. It also provides feedback on previous valuations. Example. If the fair value of the machine decreases from $50,000 to $40,000, it might indicate declining market demand, prompting the company to reevaluate its investment in similar assets. Value in use and fulfillment value entity-specific information. Value in use and fulfillment value provide information based on the entity's own expectations. Value in use is the present value of future cash flows from using an asset, while fulfillment value is the present value of cash flows needed to settle a liability. Example, value in use. A company holds a patent expected to generate $60,000 in future cash flows. The value in use of the patent is $60,000, giving a realistic estimate of its economic benefit to the company. Example, fulfillment value. If a company expects to pay $70,000 to settle a legal liability, the fulfillment value of the liability is $70,000, providing a clear estimate of the future cash outflow required. Predictive and confirmatory value. These measures help in planning for future economic benefits and obligations. They also confirm the entity's assumptions about future cash flows. Example, value in use. The company can plan for the $60,000 expected from the patent, helping to forecast future revenue. Example, fulfillment value. Knowing the fulfillment value of $70,000 for a legal liability helps the company prepare for future cash outflows, ensuring adequate financial planning. Current cost, replacement or settlement cost. Current cost provides information about how much it would cost to replace an asset or settle a liability at the current date. Example, if replacing the machine today costs $55,000, this current cost tells the company how much it would need to spend to maintain its operations at current levels. Predictive and confirmatory value. Current cost helps in planning future expenditures by providing up-to-date cost information. It also confirms the cost of maintaining current operations. Example, knowing that replacing the machine costs $55,000 helps the company plan for future capital expenditures and ensures that it sets aside enough funds to replace the machine when necessary. Understanding the similarity in titles and avoiding confusion. Dear students, I understand that the similarity in titles between the sections on measurement bases and information provided by specific measurement bases might confuse you. However, it's important to grasp the distinction between these two sections to avoid any misunderstanding. Let's clarify this. 1. Measurement bases. Purpose. This section explains the theoretical foundation and calculation methods for each measurement basis. It tells you how assets and liabilities are measured. Focus. It focuses on defining the measurement bases like historical cost, fair value, value in use, fulfillment value, and current cost. Example. It explains concepts such as fair value, the price to sell an asset or transfer a liability at a certain date, and value in use, present value of future cash flows from using an asset. Example. Fair value is defined as the price that would be received to sell an asset in an orderly transaction between market participants at the measurement date. 2. Information provided by specific measurement bases. Purpose. This section explains the practical implications of these measurement bases and how the information they provide is useful to users of financial statements. It tells you what kind of information each basis provides and why it's important. Focus. It focuses on how these measurement bases help in financial decision-making, forecasting, and performance assessment. Example. It discusses how fair value provides predictive value because it reflects current market expectations and how this information can help in making informed decisions. Example. Information provided by fair value reflects market participants' current expectations about future cash flows, helping in predicting future financial performance. Key differences and how not to be confused. Theoretical versus practical. The measurement bases section is about the theory and calculation methods, whereas the information provided by specific measurement bases section is about the practical usefulness and implications of these measures. How versus what and why. Think of measurement bases as answering the question, How do we measure? And information provided by specific measurement bases as answering the questions, what does this measurement tell us? And why is this information useful? Examples in context. When learning about fair value in measurement bases, focus on understanding it as a concept, how it is calculated. When learning about fair value in information provided by specific measurement bases, focus on understanding its utility, what information it provides, and why it's valuable for decision-making. By recognizing these distinctions, you can avoid confusion and better understand the comprehensive role of measurement bases in financial reporting. Remember, the key is to see how the theory translates into practical, useful information for users of financial statements. Factors to consider when selecting a measurement basis. 1. Relevance. Characteristics of the asset or liability. The measurement basis should align with the specific characteristics of the asset or liability being valued. For example, assets like land or buildings, which are typically held for long periods and have stable values, might be more suitably measured using historical cost due to its simplicity and reliability over time. Contribution to future cash flows. It's crucial to consider how the asset or liability contributes to the company's future cash flows. Assets generating revenue over time, such as intellectual property or long-term investments, may benefit from a measurement basis that reflects their expected future economic benefits, such as discounted cash flows or fair value based on expected market performance. 2. Faithful representation. This principle emphasizes the importance of accurately portraying the economic reality of transactions. The selected measurement basis should faithfully represent the financial position, performance, and changes in financial position of the entity, providing a true and fair view without distortion or bias. 3. Enhancing qualitative characteristics and the cost constraint. Historical cost. This basis records assets at their original cost at the time of acquisition. It provides a verifiable and reliable basis, particularly when market values are volatile or unavailable. Historical cost is often used for assets with long useful lives and stable values, ensuring consistency and comparability over time. Current value. Reflecting the fair value of assets or liabilities at the reporting date, current value enhances relevance by providing up-to-date information on market conditions. It's particularly useful for assets like marketable securities or commodities whose values fluctuate frequently and can be readily determined from active markets. 4. Factors specific to initial measurement. When initially recognizing an asset or liability, factors such as the reliability of available data, the certainty of future economic benefits, and the cost-effectiveness of using a particular measurement basis should be evaluated. For instance, the initial valuation of intangible assets may involve estimating their fair value based on expected future cash flows, market comparisons, or replacement costs. Number 5, more than one measurement basis. Different measurement bases may be appropriate for different types of assets or liabilities within the same entity, depending on their nature, purpose, and relevance to stakeholders. For example, a company may use historical cost for its property, plant, and equipment, PP&E, to maintain consistency and reliability, while employing fair value for its financial instruments to provide users with current market-based information. By carefully considering these factors, accounting professionals ensure that the chosen measurement basis aligns with the specific attributes of assets and liabilities, enhances the usefulness of financial information, and complies with accounting standards to provide stakeholders with reliable and relevant information for decision-making purposes. Measurement of equity. Equity in financial accounting refers to the residual interest in the assets of an entity after deducting all its liabilities. Here's a comprehensive explanation. Total carrying amount of equity. Equity is not directly measured, but is derived as the residual amount when total assets are reduced by total liabilities. This means equity represents the ownership interest of shareholders in the net assets of the company. General purpose financial statements. Financial statements, such as the balance sheet, are not designed to reflect the total value of an entity directly. Therefore, the total carrying amount of equity typically does not equate to A, the market value of equity shares, B, the amount that could be obtained from selling the entire company as a going concern, C, the amount that could be realized by selling all assets and settling all liabilities. Direct measurement of equity. While some individual classes of equity, such as ordinary shares, preferred shares, and components of equity, such as retained earnings, share premium, can be directly measured and reported separately, at least one class and component of equity must be measured as a residual amount. Positive and negative equity. Normally, the carrying amount of individual classes or components of equity is positive, indicating a positive net worth of the entity. However, under certain circumstances, such as significant losses or liabilities exceeding assets, equity can be negative, implying that liabilities exceed assets. Understanding the measurement of equity is crucial because it reflects the financial health and ownership structure of a company. It helps investors, creditors, and other stakeholders assess the entity's ability to generate future cash flows and its overall financial strength. By ensuring accurate measurement and reporting of equity, financial statements provide transparency and aid in informed decision-making. Cash flow-based measurement techniques. In accounting, cash flow-based measurement techniques are methods used to estimate certain financial measures when direct observation or measurement is not feasible. Here's a thorough explanation. Use in financial reporting. Sometimes, certain financial measures cannot be directly observed, especially when valuing assets or liabilities that do not have readily available market prices. In such cases, cash flow-based techniques are employed to estimate these measures. These techniques are not standalone measurement bases, but rather tools used within existing measurement bases like historical cost or fair value. Application in modified measurement bases. Cash flow-based techniques can modify standard measurement bases to better reflect economic reality or reduce measurement costs. For example, when using a fair value measurement basis, adjustments might be made to exclude the entity's own credit risk, thus refining the fair value estimate. Dealing with outcome uncertainty. One of the key challenges in estimating future cash flows is dealing with outcome uncertainty. This uncertainty arises from the variability in the amount or timing of future cash flows associated with assets or liabilities. Cash flow-based techniques take into account these uncertainties and attempt to provide estimates that are as accurate and relevant as possible. Central estimates versus range of possible outcomes. When using cash flow-based techniques, a central estimate is often derived based on the most likely scenario of future cash flows. This central estimate is selected from a range of possible outcomes that consider various scenarios and probabilities. It represents a point estimate that is deemed most informative for decision-making purposes. However, it's important to note that no single central estimate can fully capture the entire range of possible outcomes. Financial statement users may also require information about the range of possible outcomes to understand the associated risks and uncertainties fully. Benefits and considerations. Cash flow-based measurement techniques can enhance the relevance of financial information by providing estimates that better reflect economic conditions and expectations. They can also potentially reduce costs associated with more complex measurement approaches. Complexity and transparency. While useful, these techniques can increase the complexity of financial reporting. Modifications to standard measurement bases may require additional explanations to ensure transparency and clarity for users of financial statements. By understanding and applying cash flow-based measurement techniques effectively, accountants and financial professionals can provide more accurate and relevant information in financial statements. This supports better decision-making by stakeholders and enhances the overall transparency and reliability of financial reporting.